Welcome. So we're going to talk about Lombard loans, margin loans and a mortgage. So this is all the primary ways you can borrow against an asset. And I'm going to break down the strengths and weaknesses of all three of them. And to start off, I'm going to talk about the mortgage, because mortgage is the easiest one for me because I dealt with it for 8+ years, processing people's mortgages, and I saw how much pain it is to go through the mortgage application to get the loan. So, mortgage. People call it all different things, secured loan against the property, additional borrowing. There's so many different names for it, but it's all the same thing. Taking a loan against an asset. Because a property is illiquid to the bank, they're going to put the client through so much pain to get the money. So pay slips, credit score, bank statements, blood type, a lot of suffering, a lot of pain to get the mortgage. And it needs to be paid off before you retire. Yeah, so this is another one, this is another big factor, a big con of the mortgage. So not only is it a lot of friction to get the money, it needs to be paid off before retirement. So this conflicts with the buy, borrow, die framework that we're all about on this channel. So a mortgage as well, more than likely needs capital repayments. So that loan must be serviced. You can get interest-only mortgages, but again, they need those payments like a direct debit or a direct transfer every month to service that mortgage. So the bank's not going to let you off with just an interest-only mortgage, and they're going to constantly chase you every couple of years to say, are you on track to repay this mortgage? If it's an interest-only mortgage, just basically a lot of aggro, a lot of friction, a lot of pain to borrow against a mortgage. So that is not what the high net worth individuals do. This is not how we don't want friction. I don't want friction. We just want to have freedom and be treated like an adult. That's what we want. So it leaves us with the other two options, Lombard loan and margin loan. A Lombard loan sounds like it's the best way to borrow because it has a status attached to it, because it's private banks that offer it. However, it is, when you actually look under the hood, it is not as attractive as you might think. So let's break it down. The floor rate is always public knowledge. So the cost of goods sold for a bank, they have to set their loans against either US Treasury or the secured overnight financing rate. This is all set by the Federal Reserve. So the Federal Reserve essentially sets the floor rate, and the bank will offer you a rate based against that. Now, Lombard loan, they physically cannot lend to you below the floor rate without losing money. So if they are offering you less than the floor rate, they're having to make that money somewhere else. And that is normally in the form of a AUM fee, which I despise, okay? AUM fees are the biggest tax on wealth. In fact, the math is so brutal on an AUM fee that it actually works out at cutting like 40% of a client's potential wealth. So it's absolutely brutal. Avoid an AUM fee at all costs. I don't care if it's a private bank. I don't care if it's a wealth planner, the greatest wealth planner that's ever lived. Financial planners, financial advisors, AUM fees, no. Fixed fees, yes. So a private bank will make money on an AUM fee. Maybe they'll say, look, we'll take a loss on the loan, but we'll charge the client an AUM fee, because as their stock portfolio goes up, we get more money. So actually, it's within the interest to get an AUM fee and maybe cut a little bit of a loss on the loan, the Lombard loan. A private bank is a business, and it's a business with a high operating expense. They have marble floors to pay for, they have relationship managers to pay for, lots of employees to pay for. So how do they pay for that? They pay for it by their clients. Their clients pay for it in the sense of fees, hidden fees. Most of all, Forex spreads are a brutal way that they'll make up the cost of the Lombard loan. So the Lombard loan mathematically cannot be cheaper than a margin loan, believe it or not. Now you might think, well, no, I don't agree with that, because I've looked around and seen margin loans from providers that are quite high. There is an institutional brokerage that has highly competitive margin loans. On YouTube, you're not allowed to actually recommend or discuss any platforms, so I can't actually name who they are. But trust me, if you look hard enough, you'll find them, because they're very, 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 very well known. Okay, so in a bank's point of view, from a bank's perspective, if you were a bank, you're never going to lend a client less than what you can lend the US government for. Imagine, right, the US Treasury, a 2-year Treasury is 3.5%, and I'm a bank. Why would I lend you a loan at 3.5% when I can lend the US government at the same rate and have zero risk? Zero risk, because the US government will always pay me back. Client might be a good client, but they're never going to be a better client than the US government. You've got to think about that. So the cost of money is US Treasuries. US Treasuries are the price of money. That is how mortgages are decided, based on like a long-term US Treasury, and the bank just adds a credit spread. So I might say, okay, I'm not going to lend you 3.5% because that's what I could lend the government for. So I'll maybe add on 2% to that. So I'll lend you at 5.5. That's just a made-up scenario of an example. Now, my big problem with Lombard loans is a bank can change its mind later. It can say, do you know something? We need to fix our balance sheet. Not because you as a client's done anything wrong, but because the bank has a problem with its balance sheet, and we're going to get all our clients to redeem the loan. And they just send a letter, yeah, we can't offer this service anymore, please pay it back. Yeah, that's a risk, right? That's a risk that we need to address. So a Lombard loan exists at the pleasure of the credit committee. If they get scared, they call the loan. See, this is the thing with a bank. A bank is far more fragile than people actually realise. Because a bank, all of its assets are illiquid and all its liabilities are liquid. So what am I talking about? All the mortgages are illiquid assets. A bank cannot just phone up everyone who has a mortgage and say, hi, can you just pay that mortgage off right now? Okay, can't do that. However, all the liabilities are liquid. So if you have $1 million in the bank and you just transfer it out tomorrow, if I'm the bank, I have to honour that $1 million loan. I have to pay you that $1 million so you can transfer it to wherever you want to go. So banks are more fragile than people even realise. Okay, so who are they going to address first if they have problems with the balance sheet? They could easily just call the Lombard loans, because these people are high net worth, so they might be the most liquid loans they can get repaid. This would cause the client to sell stock, potentially at a loss, maybe. And then not only that, what if they're having to pay capital gains tax on those stocks that they've just sold? Not because they've done anything wrong, but because the bank's balance sheet is broke. So you've been margin called by a bank because of their balance sheet issues, and then the IRS have just margin called you straight after. So that is not good. So what causes a bank's balance sheet to go at a negative? Well, it's very simple. The inverted yield curve. So as we've addressed, a US Treasury is the cost of money. What happens if the short-term treasuries are a higher yield than long-term treasury yields? This means the bank is at a loss. See, everyone, you hear Wall Street always talking about the inverted yield curve, and they says it predicts recessions, but they don't actually tell you why. Well, I'll tell you why. Because a bank is losing money on all its loans. Okay, so all of its long-term rates are now, they're losing money because the short-term rates are higher. So we don't need to go into too much detail on that, but the point of it is that there is risks with Lombard loans versus a margin loan. Because see, a margin loan exists purely on math. Margin requirements can potentially change, which is a risk, but rarely they'll cancel the entire loan over a solvent client. You see, the margin loan treats you like an adult. It gives you full freedom, and with that freedom, you need to be responsible on the use of the portfolio, the use of the margin loan. Okay, because a broker is not the same as a bank. Okay, so let's imagine a responsible use of a margin portfolio. Okay, so let's just say you kept your borrowing around 20%. So say you have $1 million in stock and you borrow 200 grand. That's a conservative loan to value on the margin loan. But see, it depends on the individual's stock portfolio. Your stock portfolio might be defensive, whereas my stocks could be I'm investing in like tech companies which are more volatile. So I would not be wanting to borrow aggressively against that portfolio. So as at the cost of freedom is you're treated like an adult, you have to manage the portfolio like an adult. Okay, the margin loan is always interest only, and the interest is just added on to the loan. It's capitalized. It's not needed to be serviced. It doesn't need to be repaid. It doesn't matter what age you are. It doesn't matter what the credit score is. Someone could be 75 and 85, 95. They can take a margin loan, just press a button, and they get access to money. Because an institutional broker mathematically has a stronger, more profitable business model than a bank does. Yeah? A bank's business model is regulated, and there's a lot more moving parts, there's a lot more employees, there's a lot more expenses, whereas institutional broker is very lean because it's just a piece of software and it's run by algorithms. So they can pass that on to the clients with cheap margin loans. So, yeah. However, let's talk about the positive of a Lombard loan. If you have illiquid assets, such as gold, physical gold, maybe you have artwork, you have, whiskey, I don't know. You know what I mean? You have illiquid assets. Okay, fine. Lombard loan is the only type of loan that can lend against these illiquid assets. But if your portfolio is liquid, full liquid, treasury, short-term T-bills, defensive stocks, then a margin loan is just superior mathematically. Okay, so it depends on the client's, what assets the client has. Yeah, so that's why all three have their place. They serve their intended purpose depending on what kind of investor the client is. But just as far as efficiency in math and freedom, margin loan has superiority in this aspect. So there you go. Now you understand how a bank thinks, then you understand their incentives. If you understand incentives and the business model, you can see the whole game. So I hope you like the video, and if you do, leave a comment, like, subscribe, and I'll be making more. Thank you.